Let's begin our second presentation where we continue thinking about the final demand pieces in GTAP, and we actually go and look them up in the code. Okay, just as we've done before, we take out the pieces of the code, and I'm actually showing you the line numbers, so if you want to go follow those through, I'm not going to be opening my Run GTAP just yet. So at 923, 924, 925 is where the equation module's table of contents, so to speak, begins, and you see section 3, 4, and 5 are all relevant to us. The third section is on income distribution, and then fourth we have the allocation of income across expenditure categories. That is that top level regional household demand effect, or regional household consumer allocation. So all the income is collected and then is allocated to three expenditure categories: savings, government, and private. And then you get to the fifth section, actually, is where the domestic final demand equations, so where you would find the government demands or the private household, private agent demands for goods. Okay, here in line 1366 you see an equation called factor income at basic prices net of depreciation. And this is the equation that determines the factor income component of the model, so the earnings from the primary factors of production. Now, it's written a little differently than some others, and it's primarily because we don't do a lot of analysis of this equation, but it's the level Fy of that income multiplied by the percentage change, and then you see that structure on the right hand side where it's the first summing over the endowments. Those are the fixed factors of production, or the primary factors of production, and then the activities, and then EVFB are those basic price valued usage values, so firm usage of primary factors. E for endowment, A for activity, R for region, and then here's that basic price variable. All of this in percentage change, right? So percentage change in the price of an endowment at basic prices, and that's a pricing that is specific to the endowment, to the activity that is being employed in, and to the region. And then same thing here, we have the QES, the quantity of an endowment supplied, and so you end up with a value here. So this is the level percentage change. Level times the percentage change. Level on depreciation and the percentage change. We don't have to go through that one, but it's the price of investment in the beginning capital stock if you're interested. Moving down to 1385, you see the regional income equation. So it is going to adopt or carry forward this piece, the factor income. So on the left hand side we have the regional income level, income R, times the percentage change, and on the right hand side we'll have the factor income multiplied by the percentage change in factor income. Here we have, and then the remainder, of course, is that so beyond the factor income, the regional household derives earnings from indirect taxes, right? So all the taxes in the model are collected there, and so that's what the remainder of these terms are doing. And so all of this structure of level times percentage change variable is just sort of an undoing of the normal kind of share equation that we might use to break this down and only have a bunch of percentage change terms with shares where appropriate, and that's because, of course, tax receipts, these could be net, positive, or negative. So if something is going to be could change sign on you, you need to write it this way. The percentage change determination of these variables needs to be written this way. Moving on down a little further, we get some equations that we've already seen, 1409 through 1423. So remember we talked about, section 4 here is the allocation of income, regional income, across expenditure categories. And so here we have P save plus Q save minus Y. That is the price of saving, the quantity of saving. Together they make a value of saving, and it's proportional to the regional income. The spending or expenditure on government purchase goods, proportional to regional income. Private household expenditure, proportional to regional income. Now, we've talked about it already a little bit, and so we should go ahead. I've talked about the reason I was forecasting for you or an advanced topic, that CDE demand system, and I said there was something like noise or these sort of extra pieces of information required to balance things out because of this behavior. We've got this prices not being independent of the spending shares in the private household. And it's not just an issue for determining the private consumption goods and the utility level at that that utility composite for the private household, because there's a price index for that utility composite, PPRIV, the private household's price index. It gets passed up to the top level, and so we need these variables that account for these changes that occur, and those are called the utility elasticities. And so we see these terms on the right side here: UELAS-R, 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 and those are the top level adjustments that have to be taken into account for this non-homotheticity. So it's not a particular CDE effect, it's the non-homotheticity of the allocation at this component level. Because of that effect is both internal and passed forward, there's also an interior effect, if you will. So there is also a utility elasticity within the private regional household system, household demand system. So we've got this term, and this term that come from that non-homotheticity. And then we have three more terms out here that actually come from the Cobb-Douglas. So DP save, DP gov, DP priv. So we'll actually take the time to go through the definitions for those and try to give you an idea of what they do. Okay, the utility elasticity, again, I'll just remind you, it's an advanced topic. You'll get more from it later, and in fact had the chance to see the references and the actual work that was done to sort of solve this out and to identify it. But these are going to be variables that we see in the code, and that means that we need to know whether we can look past them or know why they're there. There's nothing I hate worse than saying ignore something. So I want you to have enough confidence when you see it to know that there's a reason that it's there, and to know what you're sort of waiting on, even though, again, we won't be doing much analysis that would require looking through the demand system. The utility elasticity is just the responsiveness of the cost level of utility with respect to its price index. So the non-homotheticity in the private household gives us price levels that are not independent of the consumption quantities. So you adjust a quantity, it is not done at a fixed price. That quantity adjustment in an equilibrium system means that demand went up, and so that means there are bids going up potentially on the goods that you're trying to buy, and so that price adjustment follows from that. And so we'll see those two different types of UELAS in the code. So UELAS is the top level distribution of regional income to expenditure shares. So we have that Cobb-Douglas at the top level, but those shares can't be purely fixed, And so we need this responsiveness variable. So this elasticity is written in the code, you'll see it's underlined or lowercase. So it's actually an elasticity that adjusts, it's solved for, and it gives you that responsiveness. And so it is there adjusting those shares to make them accurate, to make them true to the price system that we have in GTAP. And then you have uelastpriv or uepriv, lowercase, and that's the responsiveness of the budget shares in the private household demand to the price index for private consumption. Okay, so it's common to have questions here. We'll have a few notes for you in the notes packet and with the references. I do want to reiterate that this is a topic that we're encountering now because we're trying to work our way through the entire structure of the code. Hopefully we'll have more satisfying and detailed introduction and sort of description of what these do and what the sort of empirical, well, hopefully we'll do enough simulations that you'll understand the sort of empirical implications of having these variables in there. But the goal, of course, would be to have you be confident that you understand what these are by the end of the course. Okay, we had a few other another series of variables there that we saw, starting with DP, and that was the dp_gov, dp_save, dp_priv, and those are the distribution parameters from the Cobb-Douglas utility function. So if you write a Cobb-Douglas utility function, it has these sort of scale parameters or distribution parameters that that are not part of the substitution, not the sort of exponent, if you will. But they could matter, right? And so if you totally differentiate the Cobb-Douglas, you can differentiate with respect to the parameters too and make them into variables, and that is what has been done in GTAP. So let's go through this here. So we have the price index for disposition of regional income, and then here we have that share weighted price index definition, so all of these shares. And then we have the regional household utility function, and so this is how we calculate it. And so you see here a level for the distribution parameter on private, distribution parameter on government, distribution parameter on save. So you see all three of them in their level multiplied by the log of the percentage change of the percentage change variable, so the priv, gov, and dp_save. So traditionally these are exogenous, so they're zeros, and we don't get anything out of this. You just have this these sort of scale effects that determine the utility index so that you can actually calculate the change. So these are just the sort of initial levels. And then of course here's just an odd addition, but it's a tech change adjustment. So these price and quantity equations at the top level all have this sort of dpx variable, and it is that when you aggregate with Cobb-Douglas utility, you get a certain behavior. And so even though we just talked about utility elasticity and the fact that the shares are not truly fixed, they are approximately fixed. They don't change much. And so if you wanted to, what these DP variables do is we've given users the ability to implement different approaches to consumer theory. And so we'll get into, again, in an advanced part of the course where we look at closures in the model and different theories that people want to implement through the way they sort of set up the equations, which ones are turned on and which ones are turned off. These DP variables are going to be important. And so just to give you a flavor of that, what if you wanted to adjust the sort of base theory from the Cobb-Douglas regional household level and say that I want actual spending on the government, actual government spending to be held fixed? Well, you could use this dp_gov variable to hold the government spending level fixed, right? So the income grows, but no more spending on the government household side of the government agent portion of the regional household is made. And so you can do that. You can do that with these variables. You can enforce or impose changes through making these exogenous. You can drive expenditure to go up. You could drive savings to go up by forcing that. And then the more traditional thing is to swap one of these variables, which are exogenous and typically zero, swap them for some other instrument of the model that you believe its presence or the changes to it would cause there to be a shift in the sort of preference for expenditure at the top level. Okay, that was all a lot of it's not a lot of detail, a lot of words and a lot of explanation for something that I'm hoping we'll mostly gloss over and pass over in this online part of the course where we're just trying to prepare ourselves and get up to speed. But I do want you to note that you see these things. They're there for a reason, and in fact some of them, these DP variables, may be very important to you later on when you get into things into the advanced part of the course where you're thinking about designing your own scenarios and trying to push back against some of the structure that's been built in on GTAP as it comes on the shelf. Okay, if we made our way down to equation 1585, we would see the private consumption demands for composite commodities. These are composite commodities. Remember, we have one extra level that we're not looking at yet. So the PPA, QPA are composites for the domestic and import combined version. So this is a model that has preferences over domestic and import varieties, and that means that when we're talking about this level, we're actually saying it's a composite of all the import varieties from different potential source regions plus our domestic variety. And so we're going to treat it like it's just the commodity, but you'll when you read the notations in here, you'll see that they're calling it a composite. We already looked at this equation as the price effects, the income effects, and here it says that it defines the private consumption demand for composites. And then, of course, the left is the percentage change in per capita income. So these are standard equations. They look like we expect, and it's worth noting if you went and did your sort of symmetry or adding up or homogeneity in prices plus income check on these elasticities, they should hold up. And of course, thinking about it the other way, when we're calibrating this, a step that's done outside the model to build the parameter file, we impose those restrictions. Those restrictions are what allow us to limit the number of independent parameters, because the cross effect between two goods, with respect to their prices, has to be symmetric. Okay, and then of course the adding up condition means that once you know the elasticities in one row, all but one can be independent, and the last one has to conform to adding up. So being able to limit those gets us down to about a model where we can calibrate a full demand system by having one price effect and one income effect for every commodity. Okay, and so then we build up the full matrix of elasticities from that. Okay, so the code in the demand system, starting about 1563, you are introduced to the coefficient called the income elasticity. Moving on down a little bit below that, you get the price elasticity, or the uncompensated elasticity of private household demand for a commodity with respect to price of K, right, where C and K are the same, both over the all C, all K, but both over the commodity set. Okay, so a lot going on here. I mentioned before something about the income parameter, substitution parameter. So if you were to read backwards through the code, you would see both of those being introduced. You would also see some calculations to calculate something called alpha and something called the APE. So many of you, let's start down here at the bottom, many of you may be familiar with the Allen partial elasticity, and that is what that stands for. So the calibration within the code, or the formula for calculating the price elasticities within the code, relies on us having access to a matrix of Allen partial elasticities, and those are what we get out of a set of calculations using those base parameters subpar and incpar. This is a formula for the price elasticity, this being the consumption share for a given good. This just pre-assigns all those values to be 0, right? So you see read this formula, and it says all CK and R, and so this fills the matrix in with zeros, and then it comes in and overwrites it with these values. Okay, so there's the price elasticity. If you work your way back up, you'll see consumption shares and incpar, that CDE parameter, being used to calculate the income elasticity. So when I tell you the equation is pretty generic, but the CDE is what is giving us this set of formulas plus some others that are actually before this. I just wanted to go where these price elasticities, where the income and price elasticities are given in the code. You'll see a fairly involved set of equations. There's actually an excellent published paper that did all of this work and shows how you can implement all of this. It's a task to read through it and to do all the math and make sure it works, but this has been around for quite a while for us. The price elasticities depend on the Allen partial's income and share of consumption. The income elasticities depend on some more. But this is where we get. So this is why our demand equations look so nice to us, because a lot of work has been done to convert and write those demand equations in a nice decomposable form. Where's the trick? Where's the difficulty? Well, if you want to start changing the underlying behavior in the model, it is not, really the whole point of most of what we're doing right now. It is not sufficient to just say, I have a new price elasticity that I want to substitute in and change this for. I want to change this income elasticity. You actually have to work your way back up to the incpar and the subpar. So that is sort of where the advanced instruction topic goes. How would you go about sort of reformatting, changing the model to look more like a demand theory that you believe holds better? Okay, so the two things that we would find in our data, or in our parameter file more correctly, are incpar and subpar. These are the calibrated parameters, so we use GTAP data, GTAP consumption shares outside the model, set up an optimization program to find the closest matching set of CDE parameters to a set of target elasticities. The CDE, it's the constant difference in elasticity, and if you wonder what this is referring to when it says difference, it is the difference in the Allen partials. So the Allen partial between the paired difference between two Allen partial elasticities will hold as constant. So rather than being constant in ratios, which is sort of a tradition, this one's constant in shares. The CDE itself has moderate flexibility. It's 2n parameters, so the number of commodities times 2 is what you need, one income and substitution effect for each commodity. You don't find it estimated in the literature. Well, I say that, but I believe some people have, or at least maybe one. But what happens is we take estimates of income and price effects from the literature, high quality, cross country studies of demand, and take the elasticities from those, and then use the GTAP expenditure data, right, which may not match what was used in the estimates, and we fit the best CDE system to those literature estimates. Those calibrated CDE parameters, right, so the CDE has a subpar and an INCPAR, are what go in the GTAP model, and then we put all the formulas in that convert CDE based parameters on price and income through a multi-step formula to get the matrix of Allen partials, and then calibrate the CDE using the shares. And that'll give you the elasticities, and that's what we have. So what is our goal? Well, we want a generic decomposable demand equation. That is why we write the equation in this term, and that is why when we're early in our training, even though we're going to see a bunch of other things going on, formulas and so forth, when we go to do analysis of demand, we're going to do it on that decomposable demand equation where we can separate out the income effect and the price effect. Okay, from here forward, we will hopefully not talk so much about the CDE, but that is how the final demand system, that is the sort of true differentiating feature of demands in GTAP compared to everything else. So we tend to have a fair amount of writing and discussion of it, and that is how we've operationalized demand. So some pretty standard fare, but that CDE demand system important for producing the effects that we believe, the income effects on shares of purchases that we see hold up, empirically. That takes us to the end of this. We have a couple more presentations left, where we'll get a little more active with the GTAP code and the database. But you can proceed right now to the review quiz for this lecture, and of course reach out via email to the course contact with anything you need.